Good morning, guys, and welcome to today's edition of the London Session Open. Today is April 1st, 2019, and it's 9:30 a.m. in London when I'm recording this market update. My name is Alejandro Zambrano, and I'm the Chief Market Strategist with ATFX.com. I want to welcome you guys and hope you all had a good weekend. So we're going to take a look at the markets as we usually do at this time of the day, as you know, and see what's going on. It's going to be an exciting weekend or exciting week. We already had some Chinese data coming out over the weekend, which is better than expected. I'm talking about the official PMI, manufacturing, and also services. And then also last night we had data from the private sector, the Caixin PMI indicator, and that was also better than expected. So that's giving the stock markets a bit of a boost. So we're going to take a look at that. And we're also going to take a look at other things like the euro dollar, because we do have non-farm payrolls coming up this Friday. Before we start, though, as always, I need to stress the trading financial markets, unfortunately, is high risk, and we may lose all of our invested money. So please bear that in mind. The trading is not for everyone. A lot of people can't cope with the pressure and the stress. So also too much leverage and things like that can take, even someone experienced out of the market. Now, let's begin, and we'll talk a bit about stock markets then. So this is the S&P 500, and the S&P 500 future, because this is what we're looking at, future prices, they're up with 0.71% at the time of doing this webinar. And it's just continuing to add to its gain following good data on Friday. So on Friday, if I remember correctly, the Michigan Consumer Confidence Index was actually slightly better than expected, and that caused the market to trade slightly upwards. And then continuation now with the Chinese data actually being good. And it's a bit what I've been saying. I did a video about this, the remarkable rise of stock markets. I published that about, I think, 2 weeks ago, just before I went to Hong Kong. And what happened is that the stock markets move all the way up and then they tumbled, right? It's first after the tumble that you could see stock market, economic data weakening. Of course, there's been other drivers and other indicators weakening, but all the big important data, like from payrolls and the ISM indicator, they also declined after we saw this dip. And then the stock markets bounced, and we saw higher moves in the PMIs across the world, and things like consumer confidence improving again. So just looking at the rear mirror and use that bad data to try to project what's going to happen in the future hasn't worked here. It didn't. For some people, of course, caught it to the downside, but most people did not. And again, sort of signifies how, sort of tells how easy it is to get it wrong in the market. Now, going forward, because the data is holding up for now, doesn't mean that we can't have a recession at one point, but most likely, I think we're gonna go upwards. You might remember I said down here makes sense to buy. In fact, we talked about buying here already on March 15th. And this was a trend funding level at 27.80. Well, the market is holding up well, and we're now close to the highs. And obviously, it's too late now to get involved, I think. But if we revisit something like 28.32 or something like that, so if we go down here, then I think people might look to buy again. For this one, I'm looking to take out the high now, maybe reach 28.80, maybe down a bit, and then 29. But definitely think we're going to go upwards. And if you look at this right now, we're literally 2.9% away from the all-time high. So tell that to all the bears. Now, German DAX, and it's gaining a lot. So German DAX, I was bearish here. So you might remember I was bullish on the way to the upside and then got stopped out myself here. The market traded below support, and I had to turn bearish there according to my system. Now, the stop level for this bearishry was here somewhere, 11,647 or 50, something like that. and we are now trading above that level. So I did a little update on this morning, and you can clearly see here how the market is actually bullish, and it's no longer bearish. And if you look at from a short-term perspective, it's obviously going all the way up. It's challenging these highs, and yeah, I think we can probably go upwards, right? Probably go upwards. We are still dealing with a massive head and shoulders, just a new line drawn here. This head and shoulders been going from this to something like this and now like that. Still has the characteristics of it though. So head, left, right shoulder, and the break here could potentially lead to a significant rally. The pattern itself suggests a move towards 13,000, and we're gonna go all the way up there. I'm not sure, but the charts are telling us that if we break here, we can go definitely upwards. So maybe we'll go to 13,480, but we'll see. It's a lot of people are sort of happy that we're not heading into some sort of a imminent recession, at least now. There are other indicators like the yield curve, that yield curve inversion that is indicating a recession maybe in the US in maybe a year or so from now. So the market might, easily move down lower eventually, but for now, as you can clearly see, this is going upwards. For this trading right now on the spot, I don't really see that. Now for currencies, now the euro is going up a little bit. We're seeing a bit of a, again, on the better mood, the dollar is weakening a bit, I guess. You're seeing things like EURUSD going up, euro dollar as well, of course. I think here within a range, and let's just see what happens. Good data from the US, and we trade below 11,700 and 111.77. That can easily turn things bearish, and that will potentially create a very nice, interesting rally in the dollar. In fact, if you look at the dollar index itself, you're dealing with a big rectangle since October. You got support here, you got resistance here. So take out the 2019 high at 97.73, and we can have a significant rally of 275 points up to about 147. That would probably lead to the euro dollar again, take out the low here, probably go down to 109. Dollar versus the Japanese yen as well. I was bearish here, following the decline we saw in the markets. For now, I'm neutral here. You can clearly see how the price is just narrowing down here. There's not too much to do. In fact, with most pairs like the euro is trading sideways, GBPUSD is trading sideways, NCD, like all the big pairs are trading sideways. Here's the British pound. It's holding up all right. Let's just focus on the technicals today. So the technicals are bullish about 129.52, which we talked about over the last few weeks. We said people might buy here, which they did, and as I'm saying here, people might buy here as well. Of course, it's very high risk here. No one knows what's going to happen with Brexit, and again, for now, bullish. Crude oil, look at that. It's doing exactly what we wanted. So we talked about buying here, right? And we're now at that target. The market did, of course, take a few detours and went all the way almost to the target. Then it went all the way down almost to entry, and then went all the way up to the high again, and then almost way down to entry again, and now at that target. There's a lot of stuff going on the chart, but this rectangle here gives you this red target. Now you have another little mini double, actually it's just a double top, triple bottom, and the difference here gives you this target here. So this was a new signal here, but I would not buy here. We had 2 opportunities, actually 3 opportunities to buy at the same level. If you want to get involved here, I think we're going to go up a bit and then maybe down. So I think you need at least a pullback to 59 or so, and maybe from 59 you have a reasonably well risk-reward ratio. Stop loss on the first position and on everything else actually is 58.14. So just here. So I'm gonna go down. You risk about $1. If it goes up, you make about $2. If we go all the way up here, actually that would be $3 actually. So $3.50. So we go to this target here. But there could be more in store for this market. Still dealing with his head and shoulders, head, left, right shoulder. The break was here, the target is up here. Again, I think a lot of people sort of scratching their heads, but they don't understand that macro fundamental trading and real trading is two big different things. Most people that do all these macro reports, especially the sort of long-term guys, they don't even trade. And some people that do trade, it's always a bit funny. Like you have some of the big guys that trade hedge funds, they all say, "Oh, look, I'm very fearful for the markets. We're gonna move down and blah 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 blah." And then when you look at the actual holding in stocks, they're all long. So not sure really what's going on there. Maybe they're long, maybe they're hedging. I'm not sure. But the default position for stock markets, guys, is just going upwards. Unless you believe we're getting to World War III, unless you believe like humans have changed their views fundamentally, which they have not. Humans always want to, in a capitalist system, always want to do better. They always want to do more. They want to have more of everything. And the only way of getting more of everything is to work harder and do it more effectively. Not necessarily taking on two jobs, but again, doing things more effectively, setting up business. And that is fundamental driver of an economy of, say, the US, a lot of Western Europe as well. And as long as that is happening there, then people will push to improve their lives, and that's going to push stock markets upwards, because stock markets are a vital part, corporations are a vital part of our economies. So as long as everybody chips in and does their bit, then stock markets goes upwards. So unless that changes, so we can some more sort of, unless everybody stops working and sort of goes more socialism, I guess, or communism, probably better, then stock markets are probably going to head upwards. Once in a while you have recessions and things like that, of course, but that's it. Let's see if you guys have any questions. If you do, just put them in the chat box. There was actually an interesting chart I saw from one of the banks. I think it was BBVA, the Spanish bank. They did some interesting stuff, and I saw that, and I don't remember the actual article for that. But you know, there's always sort of fear that we're going to have sort of people borrowing too much money, and that's going to cause sort of the economy to go down when interest rates are higher. Now, I'm not really sure exactly where they found their data, and I'm looking for it right now, but I can't find it. But according to their report, there's actually not the actual expenditure on interest rate payments wasn't really particularly high for this time around. It was actually lower than we've seen for the last 15, 20 years. So let's see if I can find that actually. And if that's the case, then everybody's sort of talking about big bubble and problems, probably getting it wrong. Here we go. Let me see if I can find this. It's actually same level since 1982. Now, I don't know where they get their data from, but Federal Reserve, BLS, so all the big institutions, interest rate payments as a percentage of personal income. You can see here that interest rate payments, you know, mortgages, I guess, not effective mortgage rate because that's probably, but actually it's the part of your income that you use to pay for car loans, student loans, mortgages. Now, here we are, we're down here. So people are not taking on as much credit as it would look like. Now, again, I don't know exactly how what is. I would guess it says personal income, so it will be per household, so it would exclude maybe the Fed and things like that. But what it's telling us here is that, the Fed has increased interest rates. Yeah, definitely. But we're not sort of here or here where we reach some critical levels and people couldn't afford their spending. And this is also interesting. You have had recessions, which are the gray areas, at times of where people had little debt, and when people had high debt, doesn't seem to matter too much. And this is something that I actually read about. There's a book called is this one. This one, it was published, 2007. I bought this book just before the recession, just before the big declines in 2009. Or down here. Yeah, I must have bought it in 2007, around that time. So when it actually came out. Now, what's interesting here is that or Russell Napier, he looks at the situation in the stock markets in 1921, 1932, 1949, and 1982. Like at these years was sort of the best time to buy markets. And he analyzed articles from the Wall Street Journal, according to this, every article, which I think is unlikely. So about 70,000 articles. So he was looking at, if I remember correctly, he would look at what people were saying, I think about 2 months before the bottom and 2 months after the bottom. It was something like that, either 2 months or maybe 3 months. So you get an idea. And what he notices is that even like 100 years ago, more or less, people complaining about debt. And the reason why I keep on banging on that about to you guys is that that's sort of the main thing that these perma bears talk about. They talk about the debt, how bad that is. And yes, debt for one individual, I mean, that's not good. The system is built that if you can't pay for your mortgage, the bank is going to take your house, right? So that is true. As an individual, if you're in debt and you can't pay your debt, you're in trouble. And in some countries where I'm from, Sweden, it's even worse because they have one centralized system, so they can see more or less who you borrow money from and if you have problems paying it for it, right? So they know exactly what you're up to. But for a country like the U.S., for example, they bailed out the big banks, didn't they? The government in 2008 and 2009. They bailed out the economy many times. So what they do is that they print money that keeps the system alive, and people have somewhere to go to work. Might have 10 or 15 years of no growth or very low growth, and you have a lot of populistic parties and things, people like that, because people not happy, which I understand as well. But the key point here, they save the system so we don't go into total chaos. And what this is interesting here is that debt issue has been prominent across all these years. And we're still doing much better than we did in 1921, 1932, 1949, and 1982. Might not be happier, but materialistically, we do. So check this book out. It might open your eyes. A few years ago, I read it, like in 2007, 2008. Good book. It's not going to make you a major stock market investor. He does share some indicators and things like that to give a rough idea. But this is so long term, guys, that he talks about these massive levels. So don't read the book and then say, I'm going to wait for the next 1982. Because if you do that, you're never going to have a buyout opportunity. I mean, you can have one day, but you probably wait 20 years for that, 15 years, 10 years, because now the governments do more to save the economy than they did before. It's different. in 1921 and 1932. I think the Federal Reserve System was built in, I think, 1921-ish, 1932, somewhere here. So before that, the Federal Reserve did not really exist the way it's doing right now, which means that you didn't have that centralized push. Okay, I think we're gonna wrap things up. Guys, if you enjoyed the market update, do like the video. Check out the ATFX YouTube videos. See here if I can show you on YouTube. I had a bit of a revamp. So ATFX UK. So the way this works now is that you're gonna find the morning briefs here in this little section. I would greatly appreciate if you can go here and like some of the videos. You have as well some trading education. I haven't done this, but there's another company that's done it. Definitely want to check it out. It's hard to design a trading strategy, and a bunch of different things. And up here we have those videos where you can see me at the office, at the ATFX office. It's called Front Row. And starting from this week, we're doing one update a day here, but soon it's going to be more. But I'll let you know more about that when it's live running. But here you'll find the morning briefs. Front row is those special videos, and then you have the trading education. And if you want to know about ATFX, just head to atfx.com/UK. On that site, you'll find analysis, my morning update article. So what I'm doing now is I'm publishing a morning update most days of the week under analysis, technical analysis. You're gonna find it there, and it gives you a bit of a intro and insight to what's interesting. I call this morning brief, so you can check that out. Publish a few interesting charts and things like that. Okay, guys, thanks so much for watching. I hope you enjoyed the presentation, and I'll see you guys tomorrow, same time here, for the next update with ATFX and the morning webinar. Thank you.